So the question is now, how do you get from billions to trillions? Well, as we just mentioned briefly, multilateral banks just do offer a solution in terms of sort of scaling up the financing and increasing the impact. The next session will be moderated by Ivan Jiménez-McInnis. He's the head of partnership at Undp Istanbul. He'll be discussing that. Ivan, the floor is yours. Yeah, you're going to invite them up.
So good morning. It's a pleasure now to invite the distinguished panelists that will be joining me for this panel this morning. I would like to kindly ask Alexia Latochu from the European Bank for Reconstruction and Development, Jobst to come back if possible, Lucia Athenosy, who's a senior economist at the Council of Europe Development Bank, Mr. Jos Verbeek, manager and special representative to the UN and WTO in Geneva for the World Bank Group, Mr. Robert Schoellhammer, head of the European Resident Office of the Asian Development Bank, and finally Luis Jiménez-McInnis, director of Partnerships and Resource Mobilization for IFAD. So we seem to have an empty chair, but so Lucia, maybe you want to... Oh no, we don't actually, so we're just waiting for one more speaker. So, what do we miss? Okay, maybe we can get started because I understand we're also running a bit behind schedule if I'm not wrong. So, thank you very much for joining us today. This panel actually brings together the people that represent the institutions that we all look up to actually help us move from billions to trillions. Those that we expect will find the innovative solutions, the innovative financial instruments, the innovative models to engage the private sectors in markets that will target the communities that will host the remaining pockets of poverty. This is the institutions that we hope will spearhead our ability to actually finance the SDGs, which is the topic of our 2 days of discussions today. So in particular, we also look at them to guide us in terms of finding new ways, new approaches to actually galvanize the investments that we need, to galvanize the both public and private investments, and to actually see how we can increase our ability to find solutions to the funding gap that we have identified in terms of our ability to reach the goals by 2030. So we have invited 6 of our partner multilateral development institutions representing actually a broad array of different types of investments and different approaches. Each one of them has been asked to discuss one particular example of innovation in the financing that they're working on. And we will also ask them to talk about the development challenges that they grapple with and the solutions they have identified. So we would like them to actually look at the additionality aspect and the envisioned impact that I hope that their approaches will achieve. So without further ado, I would like to give the floor to Lucia Athenosy from the Council of Europe Development Bank, a long-standing partner of UNDP and one of the kind of more socially minded financial institutions. So.
Thank you, Ivan. Good morning, everyone. I'm very happy to be here in Istanbul today on behalf of our institution, the Council of Europe Development Bank, or CED in short. The Council of Europe Development Bank is a small pan-European institution with 41 member states and a social mandate. And because our mandate is explicitly social, there is an obvious link to a certain number of SDGs contained in the 2030 agenda. And because of this automatic link, we are actively working to further align our action to the agenda and to explicitly integrate and monitor the SDGs in our activities. The reason we are here today is to find the opportunities for working together, for strengthening our synergies, and for creating new partnerships. Only then can we mobilize the unprecedented levels of financing required to implement the agenda and to maximize our joint impact. And this brings me to one of the biggest challenges that we face as a social development bank in this context, turning the huge investment opportunities into actual social investments. And this crucially depends on how we choose our borrowers and how we adapt and innovate our financial instruments. Because the general consensus now is that a business as usual approach is no longer sufficient, we must go further. So where do we at the CEB stand when it comes to adapting and innovating our financial instruments? Given the fact that the private sector is expected to play a crucial role in implementing the agenda, a core challenge for us is to open up opportunities for private sector investors, both in our funding and in our project financing. So firstly, in terms of our funding, we have developed a new instrument specifically dedicated to financing social infrastructure and explicitly linked to the SDGs. This is our social inclusion bond. Since 2017, we have issued 3 bonds totaling 1.5 billion euros. And we use the proceeds of these bonds to finance social projects in social sectors with a high social added value. In launching these bonds, our idea was to create momentum in this segment and to bring the market around to our objective, which is to enhance social cohesion in Europe. In effect, our bonds provide a new way for socially responsible investors to support projects with explicit social impact. And for each social project finance, we measure that impact and link it to the SDGs. So secondly, in terms of our project financing, our major innovation is a project that we are financing in France via a social impact investment fund called Hemisphere. The aim of the fund is to help the French government to provide emergency accommodation to highly vulnerable people, such as homeless persons, migrants, and asylum seekers. The total investment capacity of the fund is 200 million euros, and it is financed on the one hand by 100 million in equity from 6 institutional investors, and on the other hand, via a long-term loan from the CEB, from us. So what is the project about? Hemisphere purchases over 100 low-cost hotels. The hotels are then rented to Adoma. Adoma, for those who don't know, is the leading public provider of emergency and supported housing in France. Adoma then renovates the hotels and converts them into permanent accommodation centers. The beneficiaries are thus provided with safe accommodation, but also with access to health and social services and education for their children. So in what way are we innovating here? Firstly, we are providing an innovative response to the emergency accommodation crisis in France. We are providing safe accommodation, permanent accommodation solution to vulnerable beneficiaries and access to social services instead of the expensive non-solution so frequently provided by governments with absolutely no social support. Secondly, we are enabling the French government to save an estimated 40% on its emergency accommodation budget. Thirdly, and importantly, this is an innovative investment for institutional investors. In effect, in addition to the fixed rent from Adoma, investors receive a variable return based on progress made in achieving a number of predefined social outcomes. This can be the number of people placed in permanent accommodation, the number of people receiving social benefits, or the number of children attending school. And these numbers are measured every year by an independent auditor. So here we have the private sector blending funds with the public sector, all working together for the public good. And this is exactly where we want to go if we want to achieve the SDGs by 2030.
Lucia, thank you very much for this intervention, and I think we'll come back with quite a few questions on this approach, especially in terms of blending the private and the public around socially impactful initiatives. Now, I would like to give the floor to Mr. Actually Alexia Latortu, Managing Director of the for Corporate Strategy European Bank for Reconstruction and Development. Alexia, the floor is yours.
Thank you very much, Ivan. Keeping us on our toes.
Sorry.
You on your toes. So thank you, Ivan. A big thank you to UNDP. I'm thrilled to be in Turkey, and it's been about a decade since I've been to Istanbul, and since then, the city of Istanbul has changed a lot, and so has the world of development finance. So the city of Istanbul has changed a lot, and so has the world of development finance. I was amazed by the number of skyscrapers and concrete here in Istanbul. And obviously, in terms of the development finance world, we're now in a world of the SDGs. We're now in the world of a universal agenda, which I think is fundamentally important. And so for the institution that I work with, the European Bank for Reconstruction and Development, the fact that the SDGs has kept the social sectors that we saw with the MDGs, but also added the productive sectors, or sort of the hard economic sectors. So we see decent work and economic growth. We see affordable and clean energy. We see sustainable cities. We see infrastructure and innovation. Really means that for us, EBRD, we find ourselves really relevant to this global agenda. And we find ourselves very eager to contribute to this global agenda as an institution that was created with the fall of the Berlin Wall to help the ex-Soviet republics transition to become market economies. Since 1991, we've expanded 4 times, including in Turkey, and so we now work in countries that were never command economies. And EBRD learned, I think, as has much of the world, the academic literature certainly, but also, frankly, citizens who sometimes went onto the streets, learned a lot about what we mean by sustainable and inclusive market economies. So the EBRD's mandate has remained exactly the same as it's been since 1991. We believe in the power of market economies. But in 2016, we reflected quite a bit and realized that we want to see certain qualities in these market economies. So we're not interested in any old kind of market economy. We would like market economies that are green, market economies that are inclusive, that are well-governed. We were talking about governance a second ago, that are well-governed, and of course, that are competitive, integrated, and resilient, because shocks in life there will always be. So we have a compelling set of SDGs approved in 2015. 4 years later, my sense is that the clock is ticking. The clock to 2030 is ticking. And I think the question for us collectively is, are we making progress well enough, progress at scale enough and progress fast enough? And though I'm an optimist, I have to say to those three questions, no, not yet. And the work ahead of us is urgent. So what will it take? I think the UN Secretary General's strategy for financing the 2030 agenda was crystal clear in saying that the private sector will be critical to meeting the funding gaps for the SDGs. But the strategy went even further, and I think this is important. It also talked about the importance of public policies that are SDG enhancing. It talked about the importance of countries raising their own domestic resources, and importantly to the topic of today, of this session, it talked about capitalizing on innovative instruments for financing. And so, as I mentioned, the EBRD's mandate is to foster transition to market economies and to help promote private entrepreneurship and initiative. And so the private sector is baked into the DNA of the bank that I work with. And actually in 2018, 73% of our business volume was made directly to the private sector. How do we do this? Well, first of all, we provide investments mostly to the private sector in the form of loans, equity, guarantees. We do allow ourselves, and this is important, the ability to also make investments selectively in the public sector. Because sometimes it's really important to work with the public sector to unlock the opportunities for the private sector. And then, very much in line with the UN Secretary General's financing strategy, we engage in policy dialogue to help countries make the key reforms, again, to provide the opportunities for private financing to come in. And this includes work on privatization of state-owned enterprises, for example, but many other examples. And then finally, we do provide technical assistance, the advisory capacity, the capacity building that is often so needed. And I'd like to make a point that when we talk about the private sector, I feel sometimes is a little bit neglected. We often focus on foreign direct investment. And it's really important to help mobilize foreign direct investment into the countries that we work in. But helping to deepen local capital markets, I think, is an important equation, part of the equation as well. And so at the EBRD, we do a lot of work on local currency and capital market development. And indeed, in 2018, about 40% of our business volume was in local currency to the countries that we work with. Okay, so the development challenge that I now want to focus on to answer Yvonne's question around, specific innovation that we worked on is the following. There is approximately annually a 1 trillion financing gap for infrastructure, for large infrastructure in emerging markets. The good news is we know there are institutional investors. We were talking about them in the last session. They're increasingly interested. They have appetite. But there are obstacles that they face in terms of investing in our countries. Among these obstacles are the fact that they're often looking for a minimum investment grade rating, that the infrastructure assets in our countries have no track record or sometimes a negative track record. There's political risk. There's construction risk. So, to address this challenge, I want to share with you an example of a solution. And actually, the solution involves the first time that 2 MDBs, so I'm not just going to talk about EBRD, 2 MDBs work together to develop a complementary product to mitigate risk and challenges faced by bond investors interested in infrastructure in emerging markets. And this is the EBRD MIGA, so the part of the World Bank Group, EBRD MIGA risk mitigation scheme that helped to get a state-of-the-art hospital here in Turkey built in Elazig, which is in eastern Anatolia. So the goal of this bond was to help support the Turkish Ministry of Health's goal to build 30 health campuses, state-of-the-art health campuses around the country. And this specific campus in Elazig would provide quality health services to 1.6 million people. How did we do this? This is really a joint credit enhancement scheme that allowed for a 288 million euro dominated bond. This was the first green and social infrastructure project bond in the history of Turkey, as verified by one of the leading environmental, social, and governance rating agencies. And just to go into a bit more detail on this scheme. So EBRD, we leveraged our AAA rating and pledged to provide 89 million euros for interim liquidity to mitigate risks during construction, one of the challenges I mentioned, such as cost overruns and delays, and during operation, such as debt repayment delays. And we call these unfunded liquidity facilities. MIGA, the Multilateral Investment Guarantee Agency at the World Bank Group, provided a 20-year political guarantee in support of 288 million euros of the 288 millions bond, as well as a guarantee to the equity investment in the project, which covered things like currency inconvertibility and non-transferability, expropriation, and the breach of contract. And so the combination of EBRD's unfunded liquidity facility with MIGA's political risk insurance resulted in Moody assigning this bond a rating of Baa2, which was 2 notches above Moody's rating of Turkey at the time of Ba1 stable. And the rating of this project held, even as unfortunately Turkey was further downgraded. And so our sense is that this product has a very strong potential to be replicated, and we're very happy to talk about any institution about it. And the Global Infrastructure Hub, if I can do a bit of marketing, actually did a nifty little case study on the structure of this instrument, so you can look it up on the Global Infrastructure Hub's website. But we think it has the possibility to be replicated, particularly in countries with a sub-investment grade, but that has experience with public-private partnerships. So let me stop here, Ivan.
Thank you very much for that. I think we'll come back with a few questions, particularly how do you actually get more of the appetite from the private sector. But now I'd like to give the floor to Mr. Jos Verbeek, Manager and Special Representative of the UN and WTO in Geneva for the World Bank Group.
Teşekkürler, Ivan, for giving me the floor. I hope we're not going to get another explosion now I start talking, but it's a pleasure to be here. We already heard some examples of what the World Bank is doing from the EBRD. But I wanted to maybe try to focus, and actually it's building on what my colleague from the EBRD was saying, that maybe some of the innovation is not so much on the financial side, as well as this is about seeking complementarity among the various institutions with whom you are working, so that in a sense you bring synergies to countries. And through those synergies are actually bringing additional financing to projects or additional financing to whatever is needed within a country, because you are preparing and providing a de-risking of the overall public, private sector and of business environment, so that resources are actually willing to come. And actually that's what I wanted to highlight a bit today, in at least in this session, and maybe during Q&A I can talk maybe about a few other things. But the World Bank Group actually exists of 5 institutions. Most people only think about the World Bank as the International Development Association. That is our lending arm that gives money to low-income countries, but it's from the bank to the public sector. We also have International Bank of Reconstruction and Development. That is our original part of the World Bank, which was set up to help rebuild Europe after the Second World War, and then evolved into a much bigger organization or institution. And there also, of course, it is public sector resources. It's our resources going to the public sector. But we also have 3 other institutions. One was already mentioned, MIGA. This is our Multilateral Investment Guaranteeing Agency. And that, in a sense, does political risk guaranteeing on projects and of private sector, to bring more private sector resources to a country. We have IFC, International Finance Corporation. And that, in a sense, does like EBRD, actually. It's very much a sister organization of the EBRD. A little bit older, from the 1960s. But also there, it's purely interacting with the private sector. There's no money from IFC flowing to the public sector. It's only money going into debt or into equity holdings and investments in the private sector. And then last, we have an international center for investment disputes settlement, which hardly anybody knows about. It's very small, maybe have half a floor in our main complex, but it does actually quite a lot of work, because when there are investment disputes between government and private investors, or among private investors, and in the contract they have agreed that this particular agency will help with the settlement of this dispute, they actually are binding statements coming out of that. But anyway, I wanted to come back to where it says also EBRD sort of talked about, is how do you actually find the synergies among these institutions to provide more and faster and better and leverage more financing from the private sector? Because we have heard already from the various speakers that we need trillions of dollars of financing for the SDGs, if it's not in infrastructure, if it's not in the green economy, if it's not in purely the social services that need to be delivered. And we have about $200 billion in development finance available. Yeah? So clearly, if we need trillions on an annual basis for all the SDGs, and we have in development financing about 200 billion a year, we're not going to make the SDGs. And I think I'm also an optimist, but I'm also a realist, and I'm very worried that the SDGs at the moment are a pipe dream. And we really need to start not just looking at the clock, but we need to put the alarm bell on and start raising our voices that at the current pace of implementation, the current pace of financing, we are not going to reach the SDGs by 2030. It will be a total failure, and we cannot afford to make that a total failure. The next generation deserves a better world to live in than the one we live in today. So what did we do in the bank? In the bank, after the adoption of the 2030 agenda, we said, okay, how do we find these synergies among the various institutions that we have better? And how do we write complementarities? Yeah, because normally IFC goes into a country and will do an investment and provide maybe leverage private resources, but it might find a regulatory framework not very conducive to private investment. Yeah? And normally IFC is not an organization that goes and sits around the table and then discusses reform programs with the government. That is actually the World Bank's role. So we are seeking now much better a combination of the World Bank, which is the arm of the World Bank that discusses with the public sector or with the government on what type of regulatory reform might be needed to make it more attractive for the private sector to invest in a country. IFC is basically an organization that deals with transactions. Yeah? So that can deal with, okay, which private sector can we bring? Which private sector in country could we invest in? And what other private investors could we bring to a country? And MIGA is, in a sense, our guaranteeing agency that says, okay, how do we guarantee against policy reversals? Yeah? We can all get an agreement on a tariff for, say, an electricity plant today, but we all live in democracies. 5 years later, there might be a new government, there might be new priorities, there might be new tariffs, which are not necessarily helpful for the investor. So MIGA helps with ensuring and guaranteeing against these type of investments. Now, where have we tried this? We have tried this now in about, at least we have 9 pilot countries. I won't mention them all. But one of the countries is Egypt. And in Egypt, we very much work together with the government to seek on their energy program what were the shortcomings to go to renewable. Yeah, for example, Egypt had no renewable energy law in place on how, in a sense, if you would have solar panels, you could sell that back to the grid. So we helped Egypt on the regulatory side to bring more clarity in the energy and in the renewable side. We helped through IFC to bring more resources to the country to help the investments. And MIGA, in a sense, helped them to bring confidence to these investors by risk mitigating to providing these risk guarantees. And that has evolved into a sort of a $2 billion program in Egypt, to bring more investors. About half of it is, I think, private investors. Half of it is still by institutions like ours, or even in collaboration, I think, with EBRD and others, to bring the resources to country. Now, this is what we do at the project level. And I think one thing, when I was here last year, I might probably have made similar remark, that it's not so easy for an institution like the World Bank to switch from to switch from financing projects themselves to actually become an institution that is mobilizing resources. It's a big thing for an institution to change in this angle, and we see that it's going at a very slow pace, and it needs to go much faster. The other thing that needs to go much faster, in my opinion, besides, because this is really what I talk about is at the project level, yeah? And it's project by project, or sector by sector, or country by country. But we need much more at the global level, and I think what I heard already about institutions, we need to bring institutional investors to the table. And they are not coming at this project by project level basis. So we need to be even there more innovative and seek more opportunities to bring them. And last but not least, many times we hear now among the MDBs that it's not so much just about the financing. Many people say there is plenty of resources out there to bring to the table, but we do not have bankable projects to invest in. So I think the MDBs are institutions that are actually, the whole life is preparing projects, need to become much more faster in it and much more than they prepare many more projects than actually their own financing can do, so that we actually can bring these other investors to the table. So thank you very much. I will leave it there.
Thank you, yes, very much. I think a number of challenges as well towards the end of how do we actually increase the pace of financing the SDGs. But now I'd like to give the floor to Mr. Robert Schoellhammer, head of the European Resident Office of the Asian Development Bank, for his 7-minute intervention.
Thank you very much, and I'm terribly sorry for coming late. Suffice it to say my very poor IT skills with Outlook and calendars, and forgive me for interrupting the panel. But on the subject of innovative finance, I think I said yesterday on the panel on global finance, I think just about the current system has just this wealth of innovations. If you look through the different banks here on the panel, or the UN system, there's so many wonderful ideas, so many mechanisms available, and are we making full use of this one? Just a few weeks ago, I was in Bonn. The German Development Institute hosted a discussion on a report on earmarking, and UN colleagues were there in force, obviously, given the Bonn location. And one of the main topics was there on the actual funds which we as international institutions get from our different shareholders or donors or whoever. Are the institutions themselves being given the freedom to innovate? Or I think particularly it's a case that some of the institutions there were talking about the excessive earmarking of trust funds, for example, in the international bodies. I remember talking to WHO colleagues, and I think, maybe I've got the statistic wrong, but I think only 15% of WHO activities are currently funded from their actual budget itself. The rest comes from different trust funds. So it was a very interesting discussion about, are the international institutions being given enough freedom to innovate? It's a very good report, by the way. I would highly recommend to read it. The German government, BNZ, I think Norway, Holland was out there quite in force. So it's well worth reading. Because ultimately what, I think, following on from the point I made yesterday, the international institutions, whether it's the World Bank or EBRD, have an incredible amount of mechanisms and innovations currently there and available for the system. So one key question is, are we making the right decisions at the level of our boards? Are we making the right level of decisions within our institutions to make sure that money reaches the right people? And I think that the theme I'd like to touch upon today is exactly on the decisions. How are we approaching this one? Are we being as innovative as we possibly can with the current system? Because we know reforms take time. One particular point, especially with other multilateral development banks on the table, we do hear a lot slogans, billions to trillions, and of course it's much more difficult in practice. But and I'm biased here, working for a multilateral development bank, but if you look at our last capital increase for the Asian Development Bank, this gave us an additional $100 billion worth of capital to work with in our roughly 40 countries across Asia Pacific. But the paid-in ratio was only 2%. So, for example, the US put in $300 million worth of cash into ADB, but the additional capital that accrues is 10 billion, simply because it's a leverage ratio. The capital is callable, which means if we need it, they'll provide it, but that's never happened in our 50 years history. So, and I think it's a similar story for other development banks as well. If you put in $1 and you can magnify that by about 50. So, but I think with the World Bank Group has had a very substantial capital increase just recently. And so if one very obvious large solution to going from billions to trillions is actually use the existing platform, if institutions like ADB can take $1 and turn it into $50 for development projects in developing countries, should we be using that? On the SDGs, we have an extremely good collective, which I was very happy to work in the outset, with the World Bank Group, with EBRD, African Development Bank, and other colleagues, the climate investment funds. So I think there's a current replenishment discussion ongoing, which I'm very happy to hear. Are we using these things enough? Having said that, we should never ever say things can't be improved. Things can always be improved. So one aspect I'd like to talk about is on, are we making the right funding decisions within the bank? One particular venture we have currently is ADB Ventures, and I'm delighted to see that we're working closely with UNDP, particularly in Central and West Asia. This is about reaching smaller companies, particularly tech companies. Now, I was looking last night at the companies which are coming through. There's, I just love this type of technology, even though I'm not very good at technology. There's a sort of a Fitbit for cows in Pakistan, where it's a company which puts on this collar on a cow, and it gives you all the data, the vital signs, and it leads to 15% productivity on average for dairy farms. There's a lovely IT solution in Indonesia which automates, using artificial intelligence, fish feeding. Again, I think it's proven to have a 20% return on productivity of those particular fish farms. Both of the companies in question, they're small. They are small companies. These are not the large multinational corporations who are, or big consulting companies who are very well used to dealing with ADB contracts. Now, our average project size is $100 million in ADB. So for a small startup company in Indonesia or Philippines, that's going to be quite difficult to go through all the paperwork, quite simply. So what we've got is this new venture, again in close collaboration with the UNDP, ADB Ventures, which looks to take the average size of financing down from that large amount to between $500,000 and $2 or $3 million, so that we can reach out to these innovative tech type of companies across Asia Pacific, from any of our member countries, of course, but where there is that impact in mind. So with the experience I had, I talked about my time in Mongolia where I was the country director. One other example which immediately comes to mind is where we collaborated with UNDP as well. This was a country with a lot of money, foreign currency, and with 70 million animals. But they were using the foreign currency, they had to import milk from China and from New Zealand. So actually together with the UN system, we worked on a very nice project to actually help agribusiness, to help local companies produce milk. But these were not companies you could lend money to. So the arrangement we came to was a grant from ADB to the government, which then on-lent, or on-granted, on-lent, depending on where the funds were coming from, to good companies, providing technical assistance with other donors. So if you now go to a supermarket in Mongolia, you will see Mongolian-produced organic milk. Very nice, actually. A little bit expensive still, but they're getting there. After this type of arrangement, where you've actually, you've helped these companies take their baby steps with advice, technical assistance. I remember for a cashmere company we also supported, we got the retired managing director of Crombie Coats in Scotland to come and actually work in that company and actually find out, how do you market? How do you actually get a good product to the table? Again, this is now a company which is now borrowing money directly from ADB, our private sector wing, at commercial rates. You can now actually even go onto their website and get delivery from their warehouse in Berlin. So again, but the instruments we use there, I wouldn't say they're particularly, there's nothing radically new. It's a grant. In 20 years of working with development banks, I'm always amazed how, no matter how complex the financial schemes, generally it always boils down to a bank account somewhere. And where do we transfer the yen or the euros or the dollars or whatever to? So at heart, The mechanisms are important, but the most important decision is to whom do you provide that money? That's particularly important for the SDGs. And what we're trying to do with this new ADB Ventures is get money to innovative, technical companies, smart people who wouldn't normally be able to get on the ladder. This is a very important decision because I think a lot of the financial system is quite opaque, probably, to many of these companies where the jobs are going to come from and where a lot of that innovation is going to come from. So when I talk about innovative finance, I think we have to rely on innovations coming from the vast multitude of companies, smart people out there. The question is, are we talking to them? How do we engage with them? And that's why I think we need more collectives within the international system, including, of course, the UN. Thank you.
Robert, thank you very much. As you mentioned, there's a number of corporations we had. I think it's one of the questions I'm probably leading to is, actually how do MDBs also cooperate with other actors to achieve these goals? But now, I'd like to give the floor to Luis Jiménez, Director of Partnerships and Resource Mobilization at IFID. So, pleasure to have you with us.
Thank you very much, Ivan. I think I got it correctly now. Thank you. We are the little sister, little brother in the game here in terms of the financial institutions because we're also a UN specialized agency. And I just want to go back to something Achim Steiner said yesterday about countries being on the highway to global finance, and not all countries are there. And from the vantage point where we are in terms of rural development and agriculture, even the countries that are on the super highway to finance, not all of the actors within these countries are on the highway to finance. And I think the focus of my intervention would be particularly on the targeting, which is something that is very important to IFAD in terms of rural development. Just to begin, I think all of us that are looking at the world hunger figures are seeing that the numbers are actually increasing. We are at 2019, 10 years away from the SDG agenda and finalizing, yet we are now at 2010 levels of hunger. So clearly something is going wrong. We need to accelerate, we need to move forward, because here is a clear instance of where we are going backwards. And in terms of the figures and the numbers, 80% of the people that are living in extreme poverty are found in rural areas. And this is evident, and we know this. Yet we also need to figure out exactly, if we want to make a dent in this, if we want to accelerate, if we want to reach the SDGs, which are only 10 years away, we need to go A, where the problem lies, and B, invest in the areas where we can have the greatest impact on hunger and poverty. So that's something that I wanted to put on the table. To give it some context with regards to IFAD, for the period 2019 to 2021, we work in replenishment cycles of 3 years. Our membership has allowed us to do a program of loans and grants of 3.5 billion. Yet when we look at figures that we've done with our sister agencies, FAO and WFP, it is estimated that we need $180 billion per year in investment just in rural areas in order to alleviate extreme poverty and hunger. So 180 billion. For us at IFAD, I said we're doing a 3.5 billion of program of loans and grant over 3 years. That translates into, we're trying to do our biggest amount ever, 1.7, 1.8. So that is 1% of what is needed in rural areas of the developing world in order to accelerate progress towards SDG 2. So clearly, as I mentioned, we are a specialized agency of the UN, and we're an international financial institution, so we've also been looking at ways to innovate and to do things with financing, taking into account both of our hats. And the first I would mention is borrowing. We now borrow from sovereign entities, and this is something that, I mentioned we're doing this 3.5 billion program of loans and grants. We're asking our membership to give us 1.2 billion. So the rest comes from reflows, investment income, but also from borrowing, which we've done from AFD, the French Development Agency, and we've also done with KfW, the German Development Bank. And we've also, I think, taken a page from our bigger brothers and sisters in terms of the concessional partner loans in terms of replenishment, and we've been quite successful with those, with India, Finland, and France providing our first 3 in the last replenishment. But the instrument, I guess, that I want to come here is the ABC fund, the Agribusiness Capital Fund, which is something we're trying to do as a financial institution that's a UN specialized agency. Right now, our lending and our program of loans and grants, it's directly going, for the most part, to governments. And this is our first foray into working directly with the private sector, where we would be able to provide them with funds. And I think it goes to the point mentioned by our colleague in terms of, we know our funds are not enough, as I mentioned. It's 1% of what's required for rural development. So we do need to see ourselves more as assemblers of finance more than necessarily just investors in rural areas. So with regards to this ABC fund, the Agribusiness Capital Fund, I would mention it is an impact investment fund, which will leverage, I guess, private and public investments towards smallholder farmers and SMEs in the rural sector. In some, I think we're going into areas that are, too remote, too small, too risky, and too costly for people to invest in. We know that. I think it's something, when we did the initial groundwork in terms of speaking with interlocutors, they said there's a reason why there's not that many people doing this, and it's because it's very hard. So it's very clear. But I think for us, it's really something that we have been working on. It was launched in the first quarter of this year. We have first loss capital of 50 million euros, and the target for the resource mobilization for fundraising is 200 million euros. It is externally managed. We are working with Bamboo Capital, and we are working with other partners in terms of the first loss capital. We're working with the EU, with ACP, with AGRA, and I think for us this has been quite crucial in terms of the first pillar that we're using our expertise in terms of our own portfolio of around 17 billion. And we have projects in about 99 countries. So we work with smallholder farmers, we work with their organizations, we work with cooperatives. And we also, as was mentioned, foreign direct investment. There's a lot of discussion among the membership of how do we get multinationals to go into these areas. But I think in terms of our own research and the work, there was very little that was being done in the SME world, particularly of agribusiness. So how to link the smallholder farmers, how to link their cooperatives, their small associations with the multinationals, clearly a lead for the domestic private sector there to get involved as well. The second area I would mention, I think, is in terms of the size of what the ABC fund will do. And this is something that is much smaller than what the other entities that we know go down into the level they go down into, precisely because our smallholder farmers cannot absorb the amount of funding that some of these other entities provide. So we're looking at doing direct investments of about under 1 million, from about 250 to 1 million euros, and indirect investments to other financial entities that will on-lend under 5 million. So that is something that we have been working on. And finally, I would say the other element with regards to the ABC fund is a technical assistance facility, which we feel is crucial in order to prepare the groundwork, in order to really provide, I guess, the ability to present the business models, to provide the business models for the smallholder farmers in order to be able to provide a return on the investment. I think, again, the issue for us in terms of the impact is really the targeting. We are looking at smallholder farmers. We are looking particularly at youth in terms of what we're doing, and we know that a large proportion of smallholder farmers are women, so I think that's something else that's also part of the equation. We're also looking at direct and indirect benefits to smallholder farmers. This would be able to provide funds to, I guess, input providers that are also, or SMEs that are working on inputs to smallholder farmers. And I think the other aspect with the technical assistance facility, as well as just the general ethos of being IFAD, promoting sustainable agriculture and development. I think obviously being a UN specialized agency, we're doing things in a way that are obviously in line with our own environmental safeguards, but also in line with what we do as a UN system agency. And I think, yes, in line with this, it's the carbon footprint. We all know that agriculture is one of the biggest emitters of greenhouse gases. And I mean, I think for us, in terms of working with smallholder farmers in a way that they can do this properly. So just to close, I mean, I would say, I think, for us, this is a good experience in terms of trying to blend the public and the private, which is really what we have been discussing here. It really is about the targeting the smallholder farmers, and I think it's, part of the SDG agenda is that leaving no one behind, so I think we're adequately playing our role in that. And finally, I think it is in working with partnership, and again, not only being an investor, but also being an assembler of finance, given that, as we've heard, there is lots of money out there, but we need to channel it in the right direction. So, thank you.
Luis, thank you so much for this intervention. I think also giving us a different, sense of scale as well, that we need to actually hit from, the large infrastructure investment to actually some very, very niche and small targeted ones. And now, with apologies to Jos for leaving him last, but since he had a quite important intervention this morning, I'd like to kind of give the floor to him for his comments, and then we'll open the floor for questions.
I don't know whether the micro explodes, but if it does not explode, I try to send a question into the room before I start. I take up the idea of do the IFIs have enough freedom for innovation? And I ask, do we have the adequate mindset in our institutions to embrace innovation? Classically, IFIs are there. People come to ask us for money. We have not a lot of experience sometimes, I seem to see, to sell, to market, to pitch. Question. Now, being here, having the honor to be here, not only for my own institution, the European Investment Fund, but for the entire group, the EIB group, the EIB has a certain specific position in this chorus of the IFIs. First of all, because it is a group combined not of an affiliate, of 100% affiliate for some certain policy purposes, but combined of a classical sovereign-owned bank, and which is the EIB, and a joint venture between the EIB, the European Commission, the European Union, represented by the Commission, and a variety of national promotional institutions and private banks. So, EIB and EIF, EIF is evidently the smaller of the two institutions, so small is beautiful and big is powerful. The combination is, I think, a fairly good opportunity to do something efficient. EIB has a fairly known track record for investing in, both for raising fund and investing in SDG relevant projects. EIB has issued the first green bond back in 2007, yeah, has now issued the first sustainable awareness bond, its first sustainable awareness bond last year for a volume of 500 million. And EIB is the classical project financier for improvement of infrastructures, for also outside of Europe on the basis of European mandates, projects which can help to support the SDGs in the classical MDB manner. Now, perhaps the group is specifically placed to play the role of the MDBs as a broker between politics and markets, not least because it is the member of the famous EU family, and as such it is bound, considers itself bound to a variety of financial standards which the very EU legislation is based on. Of course, the EU legislation is not directly applicable, as not even to the Commission, but it is a good custom to say we stick to things like CRD4, CRR, data protection standards, and compliance standards. So this gives us perhaps a very close understanding of the concerns of the private market. And perhaps this gives us some opportunities which others might have less, or then I come back to the question of the mindset. When talking about innovation, I mean specifically for the EIF is established as an institution taking on a smaller scale up innovation through investment in private equity funds. And these are bound to invest into small and medium-sized enterprises and specifically for innovation. We also manage a huge mandate from the European Commission called InnoFin, which is also bound to further either via guarantees or via equity, innovative SMEs. But what is innovation? We're talking about technical innovation? Fine. Perhaps a word of warning, this technical innovation might bring us a market which, over time, which we today do not even see, because we are still bound to classical financial and corporate markets. When we talk innovation, we talk also about disruption, not to forget. Now, but apart from this, what is innovation? Technical innovation, yes, but what about financial innovation? That is something we have tried to think about, and we're still work in progress, together with UNDP, on the basis of the experience which we have collected in our cooperation with the European Union, which is again our shareholder, so we are very, very, very close to our heart. So innovative finance is something which you can follow up in the development of the way the European Union rolls out the budget into the market since about, I don't know, 15, 16 years. And that was the transformation, what I said before, from grants to financial instruments. But even if you talk about grants, you can have ways to cooperate. You can have the classical ways you cooperate, what also EIB did specifically in a big project in Ukraine, project in Armenia, where you let's say you combine the grant capacities which UNDP has and the capacities, the finance, the banking capacities of EIB. But you could also think about integrating the grants into innovative financial structures. So structures which allow to increase the leverage you can achieve in the private market by covering first loss pieces, for example. It is something which we had in the Juncker plan, in this Innofin equity, where the European Union guaranteed a first loss piece, which allows then the EIF/EIB to enter into the structure at a lower risk level, so at a higher tranche level, and which allows then to use the money more efficiently and to attract additional private financing better. So I think these are key elements which we should consider in the discussion. I think there is a need for a close cooperation between organisms, institutions like UNDP and the IFIs. The IFIs have a key role to bring the SDGs on the road, and but it needs to combine the finance capacities of the public more efficiently in order to get the private capital on board, because we are all in agreement, I think, that without the private capital we can forget about 2030.
Jobst, thank you very much to you and to all our speakers. Excuse me. I would like to now open the floor for questions or comments. And if you do, please raise your hand, ask for the mic, and state your name and affiliation and who the question is addressed to. So I have one here in the second row, then another question over there.
Thank you. Good morning, Erica Gerritsen from the European Commission, which has already been named a few times. I'm coming from the public policy side of things, and I talked yesterday about what we do in budget support. And I think also during those days of discussions, we've heard how it is important to bring in the private sector to contribute to the SDGs, but also how it is important to have strong public policies. So when, and as Jos is saying, that we need to bring our tools together, And therefore, while we are talking about how we can bring in tools for the private sector to be funded, we are talking little about how innovative we can be in financing the public budgets and public government budgets at national level or at subnational level. And in that, how can we actually bring our tools better together? There are tools that, well, the World Bank uses, the ADB has this, the policy-based loans. We have not really talked about these instruments yesterday and today. And I thought that maybe in this discussion today, and also having Council of Europe Development Bank, EIB, in this discussion, it could, and EBRD obviously, it could be interesting for us as Europeans also to see how we can enhance our offer in public funding, public policy funding, not necessarily only through grants, as we do in the European Commission with the budget support, but also through loans. So I would be interested in hearing your views on this. Thank you.
Thank you. There was a gentleman there and then a lady next to him.
Good morning. My name is Aris Seferovic. I'm from the Office of the UN Resident Coordinator in Bosnia and Herzegovina. And I have a question on the presentation from Lucia from the Council of Europe Development Bank. I found your presentation quite interesting. And basically ties to, in my opinion, a key question that has been raised over the last 2 days, which is how we attract private sector to invest. And the gentleman from European Investment Fund talked about it as well this morning. And as somebody who's actually coming into this whole area freshly, so to speak, that is sort of a logical question to me. How do we ensure that the return is there for the private sector? And when you talked about the social bonds and the Hemisphere Fund, if I recall correctly, I wanted to actually ask you if you can elaborate how these returns and profits have been ensured in these activities for the private sector. How were they actually attracted to your projects?
Thank you. I'm Borka Jeremic, Coordination Specialist from the Office of the UN Resident Coordinator in Serbia. Thank you very much for the very good presentations. I would like just to bring up here that we have in this particular region over 12 countries that will start this year the process of new programming cycle. We have 5-year programming cycle, and we will be discussing the cooperation in the period, development cooperation for the period 2021-2025. And it will be very interesting. We are now following a new guidance that comes from the UN headquarters on how to develop these new programs. And we are encouraged to work with international financial organizations. So we will be looking at country level at ways of interacting with your offices in our countries. If you have any early guidance or any hints to give us at this point, will be very valuable. Thank you very much.
Thank you. So we'll now have a round of answers and then hopefully another round of questions after that. So, Lucia, there was a question directed to you, and then maybe the panel can take the other questions. So.
Much for the excellent question. So the first question about how we bring the private sector into social infrastructure investment. So as we know, when it comes to financing social infrastructure, it's a small and mainly public investment. It is small compared to major economic infrastructure investments such as toll roads or airports. So this is the first reason. The public investment, because yes, social infrastructure investments lies mainly with national or regional local authorities. So what is difficult with financing social infrastructure is that this can be often unattractive to private investors because they don't see the long-term benefits, the economic long-term benefits of this infrastructure investment. So what we do at the CEB is that we need a pipeline of good technically and financially viable projects. And in this respect, what is absolutely needed, and in countries such as Bosnia and Herzegovina, that we need to build capacity with national and local authorities. So in this respect, I can mention our very constructive partnership with UNDP. This is where we bring our finance together with technical assistance provided by UNDP. Maybe this is the first question. And on the second question, when it comes to hemisphere, so how did we manage to bring the private investors, the 6 major institutional investors in France? I think what they liked about the idea is to helping the vulnerable populations. It's very important that we create now social impact with our investment, and the private investors are very pleased of helping us in this area. And of course, as I mentioned earlier, they received fixed income in form of the rent from Adoma, so they have a fixed income, but in addition to this fixed rent, they have a variable return on their investment based on the progress we achieve in terms of the predefined social outcomes we have ex ante in the project.
Thank you, Lucia. So I would like to open the panel for the other 2 questions. So any of your any thoughts, how you see the answers, but also maybe combine this with a couple of other comments around issues that came up, which is one is partnerships and the importance of partnering if we're going to go forward in securing the financing for SDGs. And the second thing is, I mean, going back to also the question about this kind of how do we crowd in the private sector, which is where I think we have the biggest challenge, around the social investment. So what are the thoughts from the other institutions? So Alexia, would you like to start?
Maybe I'll touch on the question from our colleague from the Commission around the public sector financing. And as I mentioned earlier, we're very private sector focused at the EBRD, but it's important in development to not swing from one extreme to the other, which we tend to love to do in the development space. And so public financing remains important. And I'd like to touch on the municipal level of financing that we do, the subnational financing that we do. We have an SDG around sustainable cities and communities. As we know, the world is now an urbanized world, notwithstanding the very important challenges and opportunities in the rural world that Louise identified. So we have actually developed a strong track record in lending directly to municipalities, and not just to capital cities, but including to secondary cities in many of our countries. We do this even without a sovereign guarantee. So we have about 300 projects with municipalities where we've lent directly without a sovereign guarantee to cities. Our approach is intensive in that it often is combined with some policy work, some capacity building as well to those municipalities so that they're able to actually use this financing and prioritize the kinds of key investments they need to make. And a lot of that work ends up financing a basic sort of services and infrastructure that's critical to citizens, whether it's around wastewater, whether it's around public transportation, and there's a very strong component of a green agenda in our work with cities as well, given that cities, large cities, have serious challenges around waste management, around pollution, and so ensuring that the way we finance these municipalities is helping to reduce waste. We're looking, and this is still very early days, but looking at electrification of public transportation, for example, but also leveraging the innovations that we were discussing earlier around technology, whether it's smart grids, et cetera. So just to say that your question I think was really important, and the subnational lending is critical. I mean, I think, Yvonne, to your broader questions around partnerships, I think hopefully the example was clear. I think we can do much better when we're together, but I think it does require being really honest and open about what each different player brings to the table. And sometimes I feel like our shareholders think that the MDBs are perfect substitutes for each other, and they're not. Over the years of our work, we've developed different areas of expertise, specialization, instruments networks, frankly. And I think that's where the power can be if we actually really understand each other, what our strengths are, and how we can build on each other. It does take more time. But that's okay, because I think the game is not just to finance, I sometimes get frustrated, frankly, by the billions to trillions, because it's not just about volume, it's about the quality and the ability to think at scale and really think through, how do I create the kinds of frameworks that will get me systemic impact, even if it takes longer to sort of set up these mechanisms. But if you get it right, then you can sort of replicate it at scale. But I think there is an incentive issue for colleagues, and I can feel it with the bankers at EBRD, where the message is collaborate, do this, but the message also from our shareholders is we watch your ABI, we see the volume, and I think we need to find ways to manage those tension. Our experience even with UNDP, we've had an MOU since 2014, and again, if I may be frank, for several years it was sort of nice talk, and it's more recently I feel that we're getting more concrete, but it was an investment in getting to know people to the colleague in Serbia, getting to know the people on the ground, to really be specific about what the opportunities were. We have very different instruments, very different ways of working, and understanding where the synergies are, I think are powerful when it works, but it does take time.
Thank you. Luis, do you want to start since we're...
I'll come in on just on the public sector financing. Obviously, our loans are to governments, and I think for us, though, there is this, in the last replenishment consultation, a recognition from the membership that IFAD needs to do more in terms of non-lending activities. And I think it is precisely because of the policy environment. One, for business, but also even for the smallholder farmer. I mean, land titling issues are something obviously we deal with, and it's something that we can work with governments, often not directly, but indirectly through the projects that we're supporting. But having said that, I think we also recognize the need to work with other partners like UNDP who have a longer experience and a greater niche, particularly in dealing with parliaments and other actors that may not be actors that IFAD has traditionally dealt with. We're often just dealing with Ministry of Agriculture and Ministry of Finance. To get to the point, I think, on the crowding in the private sector, I think one thing I also wanted to mention is, from our starting point, the smallholder farmer is the private sector. And I think that's where we're starting from, that smallholder farmers are a business, and we normally think of smallholder farming and subsistence agriculture, and subsistence agriculture is a failed business, basically. It's not generating profit. It's not able to sell outwards, or even to generate enough for the whole household. So I think for us that is something that is a starting point, and it is something of perspective of how you view something. But again, I mentioned, in terms of the projects and how, we're working, that there is sort of the gap between the smallholder farmer and the multinationals, or the direct foreign direct investment that we're speaking of, but also even in terms of the instruments that are available for rural areas and for smallholder farmers. I think, as I said, these are areas that are too small, too risky, too remote for the commercial banks to go to, but for the SMEs we're talking about, it's not a microfinance issue either. So there is something in the middle that has to be done there. So I mean, I think for us it really is about targeting that missing middle, targeting smallholder farmers in order to advance on that SDG agenda. But we recognize that it is not an easy task. But I think again the partnership angle is important, and knowing the comparative advantages. As I mentioned, I think. The first loss capital is coming from, ACP, EU, AGRA, and Luxembourg, who's also participating. So in essence, that is supposed to attract the investors into the ABC fund as well. So I'll leave it there.
Thank you. Jobst, please.
Just perhaps to the Commission as well try to get an answer. I mean, we have within the European Union, we have a success story. At least we feel it like that, which is the regional financing. And that is Jeremy and Jasmine, the two mandates which you gave to the, you incentivated the member states, let's say, to give to the EIB group. The one being more for the urban part, and the other one a specific fund to be invested in SMEs and to strengthen the economy of the new member states, then new member states of the European Union. I think this is something that could be thought further and could be developed further, and perhaps also outside Europe, in a sort of binding in member states, but with within a certain legal framework, which at that point in time was centralized, to lead them to develop their regional and local economy. Coming back to the UNDP, I mean, UNDP has one advantage, which I think on what the intervention here and what I also know about EIB, everybody appreciates enormously, and that is the presence on ground. That is the presence everywhere. That are the privileged contacts to governments, and this could be perhaps also used a bit more. I mean, why can we not try to raise money out of the budgets of these governments? Why can we not, let's say in the Western Balkans, pool money from different budgets of the national governments, where you need perhaps an intermediary, because there are still some reluctancies left and right perhaps, but where UNDP could play a mediator role and could play also a role to say, look, pool it together, we get a better critical mass, we can attract better capital from inside and outside of the states. I mean, we have then coming to also what from the EBRD, I mean, let's not forget, we are working together in the Western Balkans. We have the Western Balkans platform where, well, World Bank is in, you are in, we are coordinating, EIB is helping. There are models, but the models are splattered. There is here a model, there a model, and we do not sit together to see what is the lesson learned and what can we systematically set up as, let's say, 2, 3, 4 model frameworks which could apply in one region and better in another region, but clarity, reliability, certainty of a cooperation scheme between the institutions.
Thank you. Robert, for your answers and final comments.
Yeah, maybe I can come to this issue of public policy, which is of course extremely important. I don't think anybody in this room needs to know that, of course, public policy is important for the private sector. You know, the more friendly it is, the better it is, and vice versa. From ADB's side, we do policy lending, but we're still primarily a project bank. We have actually a limitation. We can do maximum of 20% per year for this type of public policy budget support. So about $6 billion maximum that would be. But the vast majority of projects that ADB funds lead to people running around with hard hats and building things. And as I said before, increasingly sitting down with tech companies and people like that. But the public policy is incredibly important. But again, I think the main point I'd make, it's not about the money. Some of the best public policy changes I've seen arise not because ADB or somebody shows up with 500 million or $1 billion, but it's because there's a good trust with the government officials in charge of the paperwork and getting things through Parliament. It's knowledge-based. It's, what do you bring to the table to persuade, to convince developing member countries, in our case, to actually adopt good policies. It's very often we get the point, you will have leverage over these countries. I don't think it really works that way. Whatever the country, if you look at what we do in China, I think we do $2 billion a year there, sovereign. It's a fraction, it's minuscule, but we're very active involved on the policy front there. Largely this is through technical assistance projects of $300,000 to $500,000. We actually sit on a working group helping with a 5-year plan, for example. We're working on elderly care, designing new systems. This is not based on because we bring money. The Chinese don't need that money. What they want are good advice, trusted advice, and effectively communicated. Where they do like the finance from ADB, because I worked in China a lot, was having the IFI, in our case ADB, come in and actually show that this is possible. So to give you the example of elderly care in China, we worked on the policy, relatively quite small money, and the Chinese are borrowing $50 million from us to actually set up a system based on a PPP model in central China. So we're actually showing that this works. But you know, it wasn't the money which got that policy going. It was good connections, trust, and above all, knowledge, I think. We also work in China on air quality in Beijing, Tianjin, Hebei. I think it's $1 billion program. But again, I remember I asked a Chinese counterpart, you know, why are you borrowing from us? Do you really need it? They said, no. What we like is having ADB, and our partner in this case is KfW. We like the convening, we like the discussions, and we like also the coordination that it brings between private sector, between government, and various other parties. So this is not about money. Another example, many countries have problems with money laundering in Asia Pacific, and they get onto the FATF, Financial Action Task Force sanctions list, or close to it. We have a technical assistance funded by, I think it's Australia, Japan, and the US. Relatively small sums can achieve a huge amount. But again, we bring in very good people. Sometimes we sit down with senior officials from the US Treasury in front of officials from these countries. Small money, but very impactful. And the best policy lending I've seen, actually, is very focused. It's not trying to change the world in one project. It's focused on, can we get country X off the FATF sanctions list? Whom do we need to bring in? Do we have that access? What's the quality of the conversation? The money is nice, not essential, I wouldn't say. But the money helps to demonstrate that good policies can work. So again, I think it's a case of getting all the ducks in order. Thank you.
Yes, last but in no way least, the World Bank Group.
I wanted to actually say something a bit silly. I wanted to say money talks. So I think money actually does matter, because we need trillions of dollars to implement the SDGs. So let's not keep the money, keep our eye on the ball. And partly that is to bring the resources to countries. Money might not matter for getting maybe some policy changes, but it does matter for us to make progress. And I want to take actually a step back and be a bit practical. So let's say we want more innovative financing in the public sector, be it at the central government level, be it at the regional level. And we should sometimes not forget, because you mentioned China. And China, of course, is over 1 billion people. We here in, okay, I forgot the name, the number of population here in Turkey, but you know, one region in China is probably as big as Turkey. So I think we sometimes need to keep that concept a little bit in mind. But I think if you look practically, and I think the EU is trying to do some initiatives, I understand, on this side, is that we're very much missing financial plans in countries to how to reach or how to invest in the Sustainable Development Goals, be it at the central level, be it at the regional level, or even be it at the local level. Although at the municipality level, I think we're going to run into a lot of capacity issues maybe. But the point is, if we don't have financial plans at the central level, we probably will not have them at the regional level. Why don't we have them at the central level? Very often that is not because there are no national development plans that are taking the SDGs into account. Or these national development plans focus on the SDGs have not been translated in budgetary expenditures or budgetary allocations. So very often all these innovative tools that we have, they would function, of course, much better if there would be a much more lead from the country itself to articulate what it wants to invest in, and what itself it thinks could be potential for private sector financing, so that we can come with our tools of helping with the policy changes that might be necessary, that we can come with the organizations like IFC, EBRD, and others who are interacting with the private sector to seek who's willing to come and who is willing to put up the financing. And then we can use the guaranteeing agencies to ensure or to do the de-risking. Well, the other thing of partnership at the country level, how UN agencies can better, say, align itself with international financial institutions, or like the ones of us, is to do joint analytical work. There is, the bank is an organization that always starts with its analytical work. We do systemic country diagnostics to identify where we think the priorities of a country are. Then we discuss with the country where they think our comparative advantage is and how that overlaps with their national priorities. And then we come in with our knowledge, then we come in with our financing, be it policy-based, be it project-based, be it IFC, be it MIGA. So the important thing is really for us, and if you want to link up with the bank, is try to get yourself involved in the analytical work that it does, or be very well aware of what this analytical work actually says. It's that the bank thinks, or the World Bank Group thinks, that the priority should be. Because then you can say, hey, because one thing our institution does very well is translating this analytical work, these conclusions and recommendations into projects and programs. That is our starting point. We still believe very much that we are an evidence-based organization. And if that evidence is there, then we think that our programs and projects need to be based on it. So that's I always say this many times. If you want to collaborate with the bank, look at its analytical work. It cannot ignore it. We do a big report in a country on where the growth poles are or where the real challenges are within public administration. That's where we will have to work because we cannot ignore it. Our shareholders read these documents, they ask at the board, where is this based on? Why are you coming with this project? So that's really, I always see as a first, practically at the country level to connect with the World Bank Group.
Well, thank you very much, and please join me, because we're really out of time and quite behind schedule, but really join me in thanking our excellent panel. I think we can continue this discussion for quite a long time around how do we actually enhance financing, how do we innovate more around financing for the SDGs. And what came across, I think, quite clearly is the importance of partnering, the importance of innovation, but also the fact that we are lagging behind and we need to accelerate. So please join me in thanking our partners and enjoy the coffee break.